Good afternoon. Today we're going to take a closer look at President Trump's new tariff announcement and the immediate market reaction we saw this morning. Markets were pretty rattled yesterday as investors are digesting what these new trade barriers could mean for economic growth and obviously global relations. To explain what's happening, we're going to take a look at two charts, unpack how that trade policy might create these ripple effects across the economy and some markets here. First, let's take a look at this chart showing some of the new reciprocal tariffs that were announced. These are called reciprocal because they're based on how each country has been treating U.S. goods and our trade deficits with those countries in the past. It's because of this we're doing that, which is interesting and makes it somewhat more challenging in the world of negotiations. Every trade partner now faces a baseline 10% tariff. New tariffs include 34% on China, 20% on the European Union, and 25% on all imported automobiles. These are in addition to existing tariffs. So for an example like China, that total now comes to about 54%. Canada and Mexico are still facing earlier 25% tariffs that were related to other concerns the administration has. Like Trump's first term, these numbers could and will most likely shift over time as negotiations start to play out here over the coming weeks. This next chart shows a spike in economic policy uncertainty, which is probably pretty obvious, driven by these tariffs, other taxes, and other recent policy shifts. While there are certainly valid arguments on both sides of a tariff debate, markets generally worry that these tariffs will lead to higher consumer prices, as companies who now have to pay these tariffs will traditionally pass on those increased costs to us as buyers. Due to our economy battling inflation pretty heavily over the last 3 or 4 years, at least in my opinion, this is without a doubt the number one concern, right? We're still trying to get inflation down to our normal targets, and now we're faced with a pretty substantial increase in some of the cost our companies have to pay to acquire these goods and services on our soil for us to buy them. So we're already seeing an impact to earnings. Forecasts for 2025 earnings growth have been cut already from 14.2% to 11.5%, and further reductions will most likely follow if these tariffs stick around and costs continue to rise and margins get tighter and tighter and tighter because of that. What sectors be hit the hardest? Typically, sectors with heavy international exposure will feel this the worst. Sectors like technology, materials, communication services, consumer staples, and even energy. They'll likely be hit the hardest, especially if other countries respond to our tariffs with tariffs of their own. So that's definitely something to keep an eye on how these negotiations go. So lastly, while it's hard, we remain focused on what we can control. You'll never find a time in the market where there isn't some level of uncertainty. Obviously, there are times where there's more uncertainty than normal, but it never disappears. The difference with a tariff-based sell-off that we're seeing over these last few weeks, and specifically today, is that it can always be removed. When you have an earnings slowdown or unemployment starting to rise or inflation is there, these are harder economic concerns to fix, and they take a longer term time frame to get fixed. Versus in a tariff situation, if countries come to the table over the next few weeks to negotiate and the administration accepts, within a matter of weeks, it could, and I definitely say could, who knows, it could all be behind us, which is why we believe staying the course here and frankly taking advantage of some companies that have lower prices is going to be our course of action. So lastly, I appreciate you taking the time to watch. We're definitely going to post more as we learn more. And as always, if you have any questions, never hesitate to reach out. So we'll talk to you all soon.